Is this soaring AI stock the opportunity of the decade, or a textbook value trap just waiting to crush retail traders?
That is literally the multi-billion-dollar question hovering over the entire tech sector right now.
Yeah.
It really comes down to whether you believe the future promises more than you fear the present reality.
Yeah, and if you're listening to this and trying to figure out which side of that line you fall on, well, you are in the exact right place.
Absolutely.
But before we tear through the financials, read the insider order flow and really figure out what the trading algorithms are doing today, do us a quick favor, like this video, subscribe to our YouTube channel, and you absolutely have to leave your comments and feedback below.
Yeah, we really want to know if you're buying the hype or fading this rally.
For sure. Also, just a quick disclaimer up front. We are here strictly for educational analysis. We're looking at the sources, breaking down the mechanics of the data, and just having a natural debate. Absolutely no financial advice is being given here today.
Right. I mean, we are just dissecting the blueprint of this company to understand how the market behaves. What you do with your portfolio is entirely up to you.
Exactly. So the company in our crosshairs today is Nebius Group NV, and they trade under the ticker symbol NBIS. The date today is April 13th, 2026, and this stock is caught in just this massive, polarized tug of war.
It really is. Half the market is utterly convinced this is the backbone of the next industrial revolution.
Right.
And the other half is screaming that it is fundamentally falling apart under just a mountain of debt.
Yeah, so our mission in this deep dive is to look past the shiny press releases and figure out the actual mechanics driving this valuation.
And to understand the sheer velocity of this stock, you really have to understand the physical reality they are trying to build.
Heavy industry, basically.
Exactly. The market is reacting to what is arguably the most aggressive capital expansion we have ever seen in the tech infrastructure space. This isn't just software, this is pouring concrete.
Which totally explains the price action. I mean, NBIS is trading at $144.97 today. It's up 6.34% just in this session alone.
That's a huge move.
Yeah, and it's sitting dangerously close to its 52-week, which is actually its all-time high of $149.82. You don't just flirt with $150 a share by accident.
No, you don't. There are massive catalysts fueling this upward momentum. The primary catalyst is their attempt to basically monopolize the raw infrastructure required for artificial intelligence.
Right, because they aren't actually building the AI models themselves.
Exactly. They're building the massive digital factories that those models live inside.
Mm.
And the market is just buying this narrative because Nebius has secured the actual contracts to prove they are a major player.
And we're talking huge numbers here.
Oh, massive. The headliner is a jaw-dropping $27 billion multi-year deal with Meta.
$27 billion. That's just wild.
It is. We are talking about providing the raw, sheer compute power that Meta absolutely requires to keep their AI ambitions alive. And they followed that up with overlapping contracts with Microsoft, too.
Okay, let's unpack this for a second. If you're listening and thinking okay, big tech companies signing big contracts, that happens all the time, we really need to put the scale of this into perspective.
Right.
A $27 billion deal with Meta is monumental. But honestly, the most validating piece of news here is the $2 billion strategic investment directly from Nvidia.
Oh, for sure. That's the game changer.
It's like getting a golden ticket from Willy Wonka.
Yeah.
I mean, having Nvidia back your tech stack in this specific environment is not just some nice PR boost. Nvidia isn't just handing them cash. They are essentially fast-tracking Nebius to the front of the line for the world's most sought-after hardware.
It's the ultimate stamp of approval. When Nvidia says, we trust your infrastructure enough to pour $2 billion into it, institutional investors start foaming at the mouth.
Because it virtually guarantees they won't get bottlenecked by supply chain issues, right?
Exactly. It completely de-risks a major portion of their supply pipeline. But, the hardware is only half the equation. You actually have to put those chips somewhere, and you have to power them.
Enter the Finland facility.
Yes. The crown jewel of Nebius's expansion is their facility in Finland. They are constructing Europe's largest AI factory. It's a 310-megawatt facility.
310 megawatts. I feel like we toss the word megawatt around a lot in tech these days, but mechanically, what does that actually mean?
Mechanically, 310 megawatts is enough raw electricity to run a medium-sized city.
Wow.
Yeah. They are dedicating all of that power, plus the incredibly complex liquid cooling systems required so the chips don't literally melt, entirely to AI processing.
That is just a staggering amount of physical infrastructure.
Yeah.
But here is where the narrative hits a wall of math. Multi-billion-dollar contracts and giant Finnish mega factories sound incredible when you are pitching Wall Street.
They do.
But how does pouring thousands of tons of concrete and laying high-voltage cables actually translate to the income statement? Because when you look under the hood, the reality of building a digital city starts to look terrifying.
It really does. The financials are where gravity kicks in.
Yeah.
The future might look really bright, but the present is bleeding cash.
Yeah.
If we examine their Q4 2025 numbers, we see a massive disconnect between top-line growth and bottom-line reality.
Right. So Q4 2025 revenue came in at $227.7 million. On a percentage basis, that is a 547% year-over-year increase.
Which is insane. Most tech CEOs would give up their firstborn for 547% growth.
Literally. But the market actually pushed back. Why? Because they still missed the consensus estimate of $247 million.
Wall Street always wants more.
They do. And it's not just a revenue miss. They posted a devastating net loss of $249.6 million for just that single quarter.
Yeah, that's a tough pill to swallow.
If you're listening and thinking, wait, they lost $250 million in 3 months, missed revenue estimates, and the stock still went up 6% today, well, you aren't crazy. It defies traditional logic.
It defies traditional logic until you really understand the mechanics of depreciation and capital expenditure.
Right.
In the infrastructure game, you cannot generate a single dollar of revenue until the facility is fully powered and operational. So that net loss is almost entirely driven by incredibly aggressive capital expenditure.
Just burning cash to build.
Exactly. Over the trailing 12 months, Nebius has a capex of negative $4.07 billion.
$4 billion out the door before the factory is even finished. It's like building the world's most expensive, state-of-the-art toll booth. The massive debt is piling up, the concrete on the highway is still wet, but the cars, which are the realized revenues from Meta and Microsoft, well, they haven't fully shown up to pay the tolls yet.
That's a great analogy. It's exactly like a toll booth, yes, but one where the underlying technology required to build the cars is changing every 6 months.
Oh, that's true.
If Nebius takes too long to pour that concrete in Finland, Meta might decide they need an entirely different kind of highway. The risk of obsolescence is exactly why they are spending so fast.
Which makes sense, but that $4 billion has to come from somewhere, and it's drastically altering their balance sheet.
It really is.
And it's terrifying when you dig into it. They have total assets of $12.45 billion against total liabilities of $7.84 billion. The silver lining, I guess, is that they are holding a very healthy cash position right now, $3.68 billion in cash and cash equivalent.
Right, which they need.
But to fund this insane $4 billion capex burn rate, their debt-to-equity ratio has spiked sharply to 89.5%.
Which is a massive leap in leverage. I mean, they are borrowing heavily to ensure they finish these facilities before their competitors do. But, management remains incredibly confident.
Of course they do.
They are basically asking the market to ignore the current debt and focus on the 2026 guidance. They're projecting realized revenue between $3 billion and $3.4 billion, with an annual recurring revenue, which is the holy grail of predictable cash flow, projected at a massive $7 billion to $9 billion.
So management is promising the moon in 2026, but the balance sheet is just bleeding cash today. How are the algorithms and institutional traders reconciling that massive disconnect right now?
Honestly, they are completely ignoring the fundamentals and just trading the momentum. Technically speaking, the trend is aggressively bullish.
Yeah.
If you track the moving averages, the stock is trading miles above its 50-day simple moving average, which sits at $103.09.
And the 200-day?
It's even further above that. The 200-day moving average is all the way down at $91.10.
Okay, we have to explain the mechanism there because it's not just some neat statistic. When a stock trading at 144 has a 200-day average down at 91, quantitative trading algorithms automatically flag it as a momentum play.
Exactly.
These systems do not care about the 89.5% debt-to-equity ratio. They only care about the sheer velocity of the price action. It triggers automated buying, which pushes the price up artificially higher, and it just creates this self-fulfilling prophecy.
Yep, the momentum feeds itself. And the MACD, the moving average convergence divergence, is sitting at 8.29. In the world of algorithmic trading, that is just screaming buy.
But even algorithms have parameters, right?
Yeah.
We need to map out the key levels where this momentum might actually break.
Right. Let's talk levels. The immediate ceiling, the heavy resistance that sellers will fiercely defend, is that all-time high of $149.82.
Makes sense.
If the stock faces a broader market pullback or just fails to break that ceiling, the first safety net is today's low of $135 even.
And if it drops below that,
If institutional support vanishes there, the next major floor is the consolidation zone, way down at $119.35.
although Wall Street analysts largely believe it's going to smash right through that resistance ceiling, the analyst consensus currently sits at a moderate to strong buy.
True.
The average price target is hovering somewhere between $162 and $169. And then you have Northland Capital, who's being the most aggressive, slapping a $211 price target on the stock.
211. I mean, those targets assume flawless execution in Finland and the U.S., but there are flashing warning signs on the technical dashboard right now.
Oh, definitely.
You cannot have a run-up this violent without stretching the market's elasticity. The 14-day Relative Strength Index, the RSI, is currently at 73.12.
And anything over 70 is officially considered overbought. But again, let's talk about the institutional consequence of that number. It doesn't just mean the stock is, running hot.
Right.
When the RSI crosses 70 on an infrastructure stock carrying this much debt, institutional risk management desks often automatically start trimming their positions to lock in profits. It is a literal mathematical trigger for a cooling off period.
And we are already seeing the real-world reaction to that stretched valuation today. Freedom Capital Markets officially downgraded the stock from a buy to a neutral.
Just today.
Yep, just today. They explicitly cited valuation concerns after this recent run-up. They are acknowledging the strength of the underlying business, but mathematically stating that the stock price is completely detached from reality.
Which brings us to the most vital debate of this entire analysis, and frankly, the reason this deep dive exists in the first place. Is Nebius an undervalued tech giant in its early stages of dominance, or is this a massive textbook value trap for retail traders?
Well, the bear case is built almost entirely on the catastrophic downside risk of their current valuation. The most glaring red flag here is the price-to-earnings ratio. The trailing 12-month PE ratio for Nebius is currently 1,208.
Over 1,200. I just want that to sink in for a second.
For context, a mature, highly profitable tech stock might trade at a PE of 30 or 40. A PE of 1,208 implies that investors are willingly paying over $1,200 for every single dollar of earnings the company currently generates.
That's just wild.
I mean, yes, growth investors buy future earnings, not past ones. But when you combine a PE of over 1,000 with a debt-to-equity ratio nearing 90%, you are pricing in absolute perfection.
There's no room for error.
Exactly. The downside risk becomes completely asymmetrical. If they hit even a minor speed bump, like a delay in pouring the concrete in Finland or a microscopic supply chain issue with Nvidia, the drop from these heights will be incredibly violent.
And here is where I really have to push back hard on the entire bullish narrative. While Wall Street analysts are debating PE ratios and algorithmic momentum, we actually dug into the real order flow and the insider trading data. And it is an absolute bombshell.
It really is.
The actual human beings running Nebius, the people who know exactly what the balance sheet looks like behind closed doors, are aggressively taking profits.
The insider selling is significant, to say the least.
That is putting it mildly. The CEO, Arkady Volozh, sold $3.5 million worth of his own shares on April 1st. And here's the kicker. He sold those shares at $103.73.
Wow.
Yeah. Other top officers, specifically Korolenko and Stan, have also offloaded millions of dollars in positions. If the CEO of the company was thrilled to cash out millions of dollars at 103 just 2 weeks ago, why on earth should a retail trader be buying at 144 today?
It's a great question.
It honestly feels like everyday investors are just acting as exit liquidity for these executives. You have the C-suite securing their generational wealth at $100, while retail traders are absorbing all the catastrophic downside risk near 150.
It is a totally valid criticism, and it highlights the core mechanics of a value trap. It is incredibly common for retail traders to get trapped buying the absolute top of momentum swings, simply because of the psychological fear of missing out.
FOMO is real.
It is. They see the Nvidia headline, they see the stock jumping 6% a day, and they buy in at the all-time high exactly when the RSI is flashing overbought and the algorithms are preparing to sell.
Right, as the CEO is dumping his shares.
Exactly. However, just to maintain a balanced perspective here, we do have to acknowledge that insider selling does not automatically signal a failing company.
Sure, yeah.
Executives sell for a multitude of reasons that have nothing to do with the company's health. It could be tax liabilities, diversifying highly concentrated personal portfolios, or maybe they're just buying real estate.
Fair point.
The CEO selling a few $1,000,000 at 103 does not magically erase the legally binding $27 billion Meta contract. It doesn't unplug the 310 megawatt factory in Finland. And it certainly doesn't negate the projected $7 to $9 billion in annual recurring revenue for 2026. The underlying business is undeniably expanding at a historic pace.
That is the ultimate tension right there. The business is expanding, the stock might be severely overpriced. If we bring all of this together, the massive leverage, the overbought technicals, the insider profit-taking, and those undeniable monumental AI contracts, what does the actual outlook look like?
Well, in the short term, over the next few weeks, the best-case scenario is a minor pullback and a healthy period of consolidation. The stock desperately needs to test its all-time highs and let that overbought RSI cool off without collapsing.
Give it some room to breathe.
Right. If institutional buyers step in and hold the line around the $140 level, it builds a really solid base for the next leg up. The worst-case short-term scenario is that it utterly fails to break that 149 resistance. The momentum algorithms automatically flip from buy to sell, and the stock drops violently to test that 135 support.
And if that breaks?
If panic sets in, we are looking at a rapid descent back to the 119 consolidation zone.
And if we zoom out to the long term?
Long term, the continuation of this massive growth is entirely dependent on relentless execution. The narrative phase is over. Now, they have to actually finish building the physical data centers in Finland and the U.S.
They actually have to do the work.
Exactly. They have to rack those Nvidia chips, turn on the massive cooling systems without a hitch, and convert that staggering Microsoft and Meta backlog into realized bottom-line cash. If they execute that perfectly, the 1200 PE ratio shrinks rapidly because earnings will finally catch up to the valuation.
But if they don't?
If they delay by even a quarter or two, that 90% debt-to-equity ratio will absolutely crush them.
Which brings the entire debate right back to you, the listener. We've laid out the sheer, terrifying scale of the financial maneuvering that Nebius is executing right now to stay afloat while they try to build the physical backbone of the AI revolution.
It's a lot to take in.
It is. They are spending billions before they make billions, they are borrowing heavily against their future, and they are moving faster than almost anyone else in the entire sector.
It is basically a high-wire act being performed without a safety net over a pit of extremely expensive microchips.
It really is. And buried deep in the financial notes of our sources is one last detail that fundamentally alters the risk profile here. To keep funding this incredible $4 billion capex burn rate, Nebius is raising capital at breakneck speeds. And there is a massive move on the horizon that could change everything.
Yeah, the underlying structure of their debt is about to change significantly.
Exactly. They are preparing a looming $4 billion convertible notes offering. Now, for those who aren't familiar with the mechanics of convertible note, it is essentially a loan that can be converted into shares of the company's stock later on.
Right.
This is crucial because it introduces the risk of massive dilution. If Nebius executes perfectly and the stock stays high, the debt is manageable. But if the stock price drops, those notes convert into equity at a lower price, flooding the market with new shares.
Which is bad news for current holders.
Terrible news. This instantly dilutes the value of the shares held by current retail investors, which drives the price down even further, creating this vicious downward spiral.
It is the ultimate double-edged sword in corporate finance. It provides immediate cash to build the factories today, but it places a massive, complicated burden on the future share price.
So here is the question you need to ask yourself as you watch this stock trade over the coming weeks. Will Nebius's $4 billion convertible notes offering be the vital rocket fuel that sustains this unprecedented AI factory boom, or will it become the ultimate debt anchor that dilutes shareholders and sinks the entire ship? That's for you to keep an eye on.